Josh, so good to see you. Let's dive right into 76 years of market headlines, what market history teaches us about staying invested. From oil embargoes to global pandemics, the S&P 500 has endured decades of uncertainty and come out stronger over time. So let's break down the data and talk through whether pre and post retirees should make any changes to their portfolio. And I'd like to start with this chart. So Josh, what stands out to you here about how the market responds to global events?
Yeah, the big thing you want to see here is yes, there's going to be volatility, but over time, being in the market and staying invested is when you're going to make the most amount of money. Because unfortunately, the best days of growth of the market generally come right after the worst days of the market. So if you get out when the volatility happens and the market's down, you're going to miss that rebound, and then you're gonna lose out on a lot of gains.
Mm-hmm. Right. And it's easy to see when you zoom out that far, staying the course, staying invested is often the best advice. But if I feel uncomfortable about how I'm invested, when is the right time to make changes to my portfolio?
Well, the big thing is if you're uncomfortable with it, that means that you either probably don't have a plan or your plan is not designed for your risk tolerance.
Yeah.
And that's really where the problem lies,
Mm-hmm.
is the fact that you're probably invested outside of your comfortability level,
Mm-hmm.
and which is your risk tolerance. And we want to make sure that your plan really fits you and how you feel about the volatility so that you're not amped to make poor choices and get out in or out at the wrong time.
Right. You had the best analogy. If you're in a plan that's not in line with your risk tolerance, it's like wearing the wrong size pair of shoes, right? I love
Yeah,
that one. That was
yeah.
good. So, Josh, how does the answer change then for someone who is nearing retirement or recently retired?
Well, the big thing that happens when you're nearing retirement or recently retired is you go from this being money that you need in the future to money you need now, some of it, and that needs to be part of your plan as to what do we do for income and how do we navigate these market risks, because that's where you can really get into trouble is if we're in a dip and you need to take a withdrawal.
Right.
That's where the real risk comes.
I'm so glad you brought that up because that risk does have a name. It's known as sequence risk. This is a very unique challenge for people who are retiring into a down market. Can you explain that, please?
Yeah, the big thing is you can get the same rate of return. So we've got retiree blue versus retiree green, and they're both going to hit a 4% average, and they're both going to start out with $100,000, and they're both going to take the same amount of withdrawals every month. The big difference is retiree blue starts out with some really good years, and then the bad years come toward the end, versus retiree green, the rates are the years of returns are exactly flipped to where the
Mhm.
bad years come first and the good years are at the end, and it makes a significant difference. After 15 years, retiree blue still has all of their money plus,
Right.
and retiree green is down to only $35,000. They're down to
Unbelievable.
35% of their initial investment, and they did the exact same
Right.
thing,
Right.
but it has to do with when the returns came in what order, which is what we call sequence of returns. And that's why it's very, very important to have a retirement plan. And if you need income in your retirement plan, then that needs to be part of it. You need to have a rhyme and reason of where you're taking the income and how and why, so that you don't run into this sequence of returns risk.
Right. And so, since we have no control over what the market is doing when we retire, how do you guard against sequence risk?
Well, you got to have some safe money and some growth money and some income money. Because the reason, how you got to where you're at now is because you had that growth money and you let it grow and you let it ride and you let it roll and it grew and grew and grew. And now you have this big nest egg. Well, we still need that for the future. So we
Right.
need some of the money in our growth bucket. And then, well, you stopped going to work, so you need income. Well, some of that income is going to come from Social Security, some of it might come from a pension, but you're probably going to need some from your investments. And we need to use specific investments that create income
Mhm.
so that we don't hit this sequence of returns risk problem. That's where the dividend producing assets or annuities or something designed for income fits that.
Right.
You're also going to need some safe money. So if an emergency comes up and the market's down, you don't have to sell in a negative market to repair the house or replace your car or whatever the emergency is that came up.
Mm-hmm.
You need some money set aside for that so that, again, you're not selling at a bad time to sell.
Right. So much more than, just staying invested or buy and hold. It's about having a plan and then being comfortable with that plan so that you are not stressing out during these moments of volatility. So Josh, if somebody would like to sit down with you, either create that plan, a plan that's in line with their risk tolerance, talk more about how to segment their money to make sure that their nest egg lasts, what's the best way to reach you?
Yeah, they can call us directly at the office at 260-488-8300, or they can jump on our website at millardfg.com. And we'd love to meet with them and help in any way we can.
Great. Josh, thank you.
Thanks, Erin.